Selling an investment property and paying zero capital gains taxes is not a loophole, but it's a wealth building strategy, and it is one that is completely legal. But if you don't do it right, you could end up with a huge tax bill. And why should you pay Uncle Sam any money that you don't have to? Now, with most tax things, you could fix them afterwards. This is one, once it's done, and you'll learn why. I'm Kishore Kapoor, a real estate closing attorney in the state of Connecticut. And today I'm going to walk you through how investors can legally defer taxes using a 1031 exchange and where these deals sometimes go wrong. So we'll start out in a positive way because I love being positive. I had a client, John. John was selling a property, made a huge profit. I was like, John, how did you do this? I was impressed. I deal with a lot of closings. I'd not seen somebody turn such a great profit, but he had gotten such a good deal on this house. And John calls me right before he lists, which is probably the best time to reach out to an attorney if you're thinking about a 1031. And he goes, what are my options? I don't want to pay Uncle Sam a dime. I said, John, there's a great strategy. It's called a 1031 exchange, and you can trade houses. He goes, what do you mean? He goes, well, in essence, you're buying a house, and because you don't touch the money, the IRS says it's treated as a trade, right? You're just trading one property for another. It works out well. I said, John, there are some strict rules, and we'll go through those, and you'll learn about them just like John did. But you got to stay vigilant and sure you start looking for your next replacement property now. So Section 1031 is rules that allow you to defer, right? Not eliminating them, but you're pushing them down the road. And with some strategies, there's probably a way to defer them. You need to talk to your estate planning attorney about that one. I'm going to leave it with them. They're the experts there. But Section 1031 says you can defer taxes as long as you are buying another piece of real estate, right? It can be a residential property. It can be a commercial property. It could be an industrial property. You can go from a single family to a multifamily, right? As long as it continues to be real estate. You need to spend all the money you're making so you don't get any of the money out of the deal. If you had a mortgage on the property, you either need to replace it with cash or a mortgage. You can't go and say, I had a $200,000 mortgage. I sold a $500,000 house, and now I'm going to take out a $500,000 mortgage and pocket the money. It doesn't work that way. The other thing is you have 45 days to identify the property, which means when you go to find your new property that you're going to buy, you have 45 days from the date that the sale takes place to the date that you get under contract realistically. And then 180 days to close. That is key. It's 180 days, not 6 months. The most important part of this is this plan needs to be put in place before the first property sells. Can't do it after. So for John, it worked out well. John turned a huge profit, bought an investment property that was worth more than the last, and put more money in his pocket each month because it made more income each month. Plus, the property probably grew in value, so it did benefit John both ways. Now, there's every client that listens to you. For every client that listens to you, there's one that does not. And that's Debbie Downer. Debbie decided that she wasn't going to listen to anybody's advice. Not a realtor, not a mortgage broker, not her accountant, not even her attorney. She decided she was going to go online and start Googling to get her information. And we all know how that goes. I think Abe Lincoln said 86% of statistics made up online are completely made up, right? Go figures, right? Abe Lincoln was alive when the internet was first created. Just proves my point. So Debbie decided that it was a great idea to just start Googling things, come across some advice, and follow it. Well, the advice Debbie got is she could sell her multifamily house and go and buy a commercial property, which she could do, but she could buy it and get the money and hold on to it. That doesn't work. IRS says, nope, That's considered a completed sale. Pay us our money. So Debbie sold her property, bought something new. Time goes on. April 15th of the following year rolled around. She got a big fat tax bill. Debbie was not happy. And unfortunately, because she didn't have any professionals that she relied on, and we all gave her advice. I know that because I got on a call with her accountant and myself and the 1031 company that's called the Qualified Intermediary. We went over everything with her. She didn't listen. She said she knew more than us. Like, yeah, that hurt. That really hurt. But you know what hurt more? A huge tax bill. Even worse, one that was completely avoidable. Her entire team was telling her that she got it wrong, but she trusted the internet more than her attorney. It happens. So you cannot touch the money. Your attorney cannot touch the money. The qualified intermediary is the only one who can touch the money, and that's the third party that will handle all your 1031 exchange funds. That being said, listen to your attorney. That's a great lesson. The second great lesson is be aware that 1031s have to be done prior to closing. So let's go on to another client, Randy. Randy had listened to our advice. He didn't start Googling, but Randy had a misunderstanding. And I don't fully understand why, but I do understand why, and I'm going to explain. So Randy had sold his home, not his home, but sold the property. And he was planning on buying a huge commercial development, which is perfectly fine. It's actually a great idea, right? Made a buttload of money on a residential rental property, decides he wants to go commercial, feels like it was a little bit less emotions, a little less work. I don't know if I agree with that, but that was his decision and I supported it. And I think it was a great decision, not for his reasons, but he made more money. Well, Randy was going through the process. He found a property on time. He'd called us early enough. We explained the whole process to him. I kept telling him it's 180 days, 180 days. And I say that because I know people don't always understand the difference between 180 days and 6 months. Last time I checked, there's 365 days in a year. So it doesn't work out equally. But somebody had told them 6 months instead of 180 days. I'm going to guess, if I had to, it was the internet because a lot of people just rely on what they read on the internet. It could have been AI, who knows? But Randy ended up missing the 180-day deadline. And we don't do commercial closing, so I didn't help him with it. I don't know why it got missed, but I know it got missed. The IRS does not care. It could snow on Tuesday. There could be a tornado. There could be a hurricane. Unless the IRS says you get an extension, you don't get an extension. Your cousin could be sick. Your daughter could be sick. Your wife could be sick. You could have had a new baby. IRS doesn't care. It could have fallen on Christmas. IRS doesn't care. Moral of the story is it's 180 days and the IRS doesn't care if it's 181. You're paying taxes. So don't pay taxes if you can avoid them. And with an 1031 exchange, you can avoid them. So if you're thinking about selling a property that you held for investment purposes, give me a call before you list it. Because there's things we should try to do up front to help save you time and money and make sure you don't end up like Randy or Debbie Downer and you end up like John. So, as always, if you found this information valuable and useful and you don't want to end up like some of our clients that ended up in hot water with unnecessary tax bills or rough closings, be sure to follow us so you can learn from my clients' mistakes so you don't make the same ones. And at Connecticut Real Estate Closing Attorneys, we help prove the American dream is alive and well, one closing at a time.